Welcome to the Look Forward podcast from S&P Global. My name is Molly Mintz. I'm the lead strategist for research and development at S&P Global Ratings. In today's rapidly shifting markets, success depends on anticipating what's next on the horizon. The experts who excel are professionals who can spot emerging trends before they fully materialize. With the Look Forward podcast, you can access the forward-looking intelligence you need to navigate uncertainty with confidence. The Look Forward podcast delivers fresh insights, deeper analyses, and innovative approaches that are essential in this rapidly changing world to help you prepare for future risks and opportunities. We bring you specialist perspectives on capital markets, trade and supply chains, the multidimensional energy transition, sustainability and climate, global realignment, technology and digital disruption, and beyond. This podcast connects you with S&P Global's Look Forward Council, bringing cutting-edge research on long-term trends and transformative market shifts with a sharp focus on what these developments mean for the decisions that will shape your tomorrow. I'm looking forward to always learning with you. With aggregate hyperscaler data center capital expenditures expected to total $625 billion by the end of 2026, the rising tide of artificial intelligence investment shows no sign of slowing. This boom is also lifting the players that supply the ecosystem, spanning technology firms, chip makers, data center developers, AI labs, and beyond. In the near term, demand appears to be clearly outstripping the supply of new data center capacity, with corresponding investments materially boosting growth in the broader U.S. economy. A key question on investors' minds is whether AI adoption and monetization will accelerate enough to turn this early investment-led economic boost into lasting productivity and financial returns. As funding for this expansion moves toward the debt markets from equity markets and hyperscaler cash flows, talk of a potential market correction is increasing. Equity volatility may not necessarily translate into a credit correction, but S&P Global Ratings believes risks in some segments of the ecosystem have grown, stemming in part from the surge of investments that increasingly rely on debt and the rise of increasingly complex and circular financing structures. On this episode, I'm joined by my S&P Global Ratings colleague, Pierre Georget, Managing Director and Head of Infrastructure Research, to go deeper into our recent research on the credit risks of data center development. Pierre, welcome to the Look Forward podcast.
Thank you very much, Molly, for having me. I'm delighted to join this Look Forward series. And you know what? It's always refreshing to take a step back from day-to-day market noise and focus on what is structurally shaping the future. So, as you just said, I lead our global infrastructure research, and my role is to help define and coordinate our views across sectors such as transport, energy, and digital infrastructure. So data centers have by far driven most of our market discussions over the past quarters, and we are seeing it as a true megatrend, with transactions taking place in the US, in Europe, in Asia Pacific, and even in emerging markets. They involve hyperscalers, private equity, infrastructure funds, industrial operators, and we have a diversity of financing structures supporting this growth. And that's fascinating. So we see traditional corporate financing, we see project finance structures, we see structured finance solutions. And it's quite funny because data centers are in many ways an old asset class. But at the same time, they are being completely redefined by cloud computing, AI, energy transition constraints, and even digital sovereignty. So our objective within ratings is to combine all of these lenses to provide the most comprehensive and forward-looking insight on what has become one of the most strategic segments of global infrastructure. So I'm really looking forward to this discussion.
And I'm so excited to get into your subject matter expertise today. So it's only fitting that we start the conversation from your infrastructure perspective. We're talking about this recent data center and AI investment boom. And S&P Global Ratings data shows that from September of last year through February 2026, there's been a significant uptick in global high-tech bond issuance on the back of hyperscalers totaling $260 billion in issuance. At the same time, we've observed that investments in data centers are only roughly 1.5 trillion of the 5 trillion in broader AI related investment that we expect through 2030. That's only, 30%. So my question for you, how do you expect the outlook for the global infrastructure industry to continue to be affected by this trend throughout this year as investments in AI and data center infrastructure continue to be the primary drivers of growth across various sectors?
And that's a very timely question because, as you can imagine, it's the beginning of the year and we recently published our 2026 trends for infrastructure. So it's all fresh. And what is really striking is how many of these trends are directly connected to the acceleration in AI and data center investments. So the first theme across the asset class is about growth. AI-driven capex ambitions, particularly from the hyperscalers, remain extraordinarily strong. And you already mentioned these stratospheric numbers in your introduction. So guess what? They keep growing, and that translates into sustained demand for data centers and in turn a surge in power demand. This dynamic is especially acute in the US, where connection queues and power availability have become strategic bottlenecks. And it's important to stress that it's just not about demand for power, actually, it's demand for access to power. And that distinction matters. It means that both grid expansion and access to firm capacity matters. In some region, that favors gas. At the same time, if operators can secure clean power, they will. So, which keeps renewables very much in demand. And we are also seeing a clear revival of interest in nuclear, both for their baseload stability and decarbonization objectives. It is also increasing pressure on the whole equipment supply chain, and I know we will come back to that during our discussion. But going to that second major theme across infrastructure, it's affordability. Here, investments across infrastructure assets are reaching record levels, and that's true for power generation, that's true for the grid, that's true for digital infrastructure. And higher capex often translates into higher tariffs for customers and greater fiscal pressure for taxpayers. In that context, the rapid expansion of data centers combined with inflationary construction and equipment costs, notably due to higher demand, but also because of the introduction of trade tariffs last year, make digital infrastructure and data centers in particular a visible and easy target to blame. For utilities in particular, one key risk is ensuring that data centers pay for their fair share of network and capacity cost. And if it's not properly structured, the financial burden will in the end shift to the smaller businesses, which would increase the political pressure and regulatory intervention risk. And that perception risk is just as important as the financial one. The third theme is environmental and climate constraint. Greater electricity demand, and that's regardless of the source, creates tension with decarbonization pathways. It's quite clear that climate has moved lower on the political agenda in most jurisdictions over the past year. But the reality is that the structural challenge remains. Meeting AI driven growth while staying on track for emission targets requires long term planning, massive grid investments, and credible low carbon strategies. And finally, still on climate, resilience is becoming central. Infrastructure systems are being asked to grow rapidly, decarbonize, and at the same time become more climate resilient. So, again, for utilities, the financial equation is quite complex. How do you fund expansion? How do you strengthen the resilience against physical climate risk? How do you maintain affordability and at the same time credit quality? So overall, when you look at this AI and data center story, everything is amplifying existing structural themes across infrastructure assets, growth, affordability, energy transition, and resilience.
All right, we're talking about affordability risk, perception risk, financial risk, climate risk, risk. I want to move on to talk about execution risk, which is something that really stood out to me in a recent report that you published. And I'd love to get into the nitty gritty with you on understanding this. So, in this recent research, you wrote that the rapid development of data centers is creating vulnerabilities, and you said that data centers are generally considered relatively easy to build, but new projects require infrastructure and construction coordination that can compare to building entire cities, typically on timetables of just a few years. So, obviously, as a result, the rapid pace of this data center infrastructure and development, particularly in the US, which I think obviously for our audience, this is really where we're talking about, is really reshaping the risk profiles of developers and their partners. The size and speed of construction, the technical requirements, these can create pressures for subcontractors and suppliers that may have limited experience, balance sheet strength, and risk management for these types of stratospheric projects. Love that word that you used. So, with this in mind, how can execution risk challenge data centers' credit quality?
Thanks, Molly. And indeed, when we talk about execution risk for data centers, I will distinguish between really two phases. So the first one is the construction risk. The other one is the operational risk. Both clearly matter for credit quality, but they materialize very differently. So let me start with construction risk, which is first the most immediate one, because simply because we are entering into a phase where projects are being launched at an unprecedented scale. So when you look at a data center in isolation, it can be a pretty standardized asset. The problem is that what is being built today, as you just said, is not a single facility. It's a massive multi-building campus delivered at a record speed. And let me take one emblematic example, which is Meta's Beignet project in Louisiana. Here we are talking about roughly $30 billion, 30, so 30, just for the shell. That is just another industrial building for sure. It's effectively a small city, and it needs to be delivered in less than 3 years. So, on top of the real estate component, you also have to install highly specialized equipment. You need to secure incremental power capacity. You need to build new grid connections, and you need to coordinate very closely with utilities, EPC contractors, technology suppliers, and local communities. So, where we stand now is that the level of logistical and financial coordination which is required is enormous. What makes this even more challenging, in our view, is that less than 2 years ago, data centers were still a relatively niche discussion outside of specialist circles. And today, the entire ecosystem is ramping up simultaneously. Developers, contractors, equipment providers, utilities, and they're all doing so on an asset class which is itself evolving extremely quickly due to ever changing AI technological requirements. So, if you like cooking, you now have all the ingredients to see increasing risk of delays, cost overruns, and design adjustments. And in fact, what we are already observing is that construction delays of over 3 months are happening on a significant share of projects currently under development. Another important dimension of during the construction phase is the risk distribution. On one side, you have the hyperscalers, and they generally have a very strong balance sheet, significant financial flexibility, and they can easily play the AI race. But many other participants in the ecosystem, like the ones we just mentioned, developers, contractors, operators, they are taking on substantial operational and financial risk to keep pace. For some, these are the largest contracts they have ever signed. And that can mean higher leverage, tighter margins, and more exposure to execution setback. So that's on the construction phase. And that maybe let's now turn to the operations. Once the assets are operational, the focus shifts from construction execution to contractual structure and counterparty risk. Here, one of the key issues which is specific to the asset class is transparency, or I would say the lack of transparency. The AI ecosystem remains relatively opaque and often for competitive reasons. So that means that it is possible that some operators may be entering into transactions without the full transparency they would usually require to operate. And this can be on the ultimate demand drivers, this can be on usage profiles, or even the broader financial resilience of certain counterparties. Also, in some cases, the negotiating power may not be balanced among the parties. For the weaker players, it can feel closer to a take it or leave it dynamic, which we believe could increase risk tolerance. With all that, for credit analysis, what it means is that we pay close attention to contract duration, termination clauses, pricing mechanisms, concentration risk, and the true financial strengths of counterparties. Now, I realized what I just said is quite a lot to digest, so let me rephrase that in short. Execution risk in data centers is twofold. First, the challenge spreads across the supply chain on building at scale and at speed. And second, ensuring that once it's operational, the contractual framework supports adequate risk sharing and long term resilient cash flows.
You asked earlier if I like to cook. I can't recall the last time I used my oven, but I am an expert at making reservations. And in my book, there are many winning and losing restaurants, which makes a perfect segue to my next question. So, Pierre, who is likely to emerge as the ultimate winners and losers in this data center AI ecosystem? Who is going to eat the other's lunch or dinner? Where are the ultimate credit risks and rewards within the AI infrastructure build out?
First of all, I really like the way you frame the question in terms of winners, losers, and because that's very much how we see the current phase of AI development as a race. Clearly, very few people today doubt that the transformative potential of AI. It has the capacity to reshape how we live and work, how the entire industry operates. But history also teaches us that technological revolution rarely follow a straight line, and they tend to produce a very small number of dominant winners and a very large number of challengers that fall behind. And often that translates into episodes of financial dislocation. What makes the current situation particularly interesting is that we are talking about digital infrastructure. And with infrastructure, we have assets which are long lived, capital intensive, and typically supported by long term contracts. So, on paper, that sounds quite stable. But yet, that stability depends significantly on the technology risk. And frankly, we just have no idea of which AI model will ultimately prevail, what the long term pace of adoption will be, and how quickly hardware requirements may evolve. We can easily imagine that a shift in chip architecture, cooling technology, or computing efficiency could materially alter the infrastructure needs. And that uncertainty feeds directly into counterparty risk along the value chain. So, as a result, diversification becomes more important here than it might be for the other more mature infrastructure segments. Exposure to a single hyperscaler, a single technology generation, or a concentration on one tenant base can significantly amplify the risk in an environment where the underlying technology is evolving rapidly. That said, as in any race, some participants are better positioned. In power, for instance, owning generation assets. That's quite positive. Securing reliable power has become such a strategic differentiator in the ecosystem that it also comes at a price. And this means tailwinds for the generators over the coming years. Experience also matters. So, operators with a long track record in digital infrastructure, diversified portfolios of data centers, and a broad tenant base are generally better equipped to manage the technological transitions and negotiate balanced contractual frameworks. If we turn to the developers or the contractors, procurement capability is increasingly critical. The ability to secure equipment, and here we're talking transformers or cooling systems, for instance, if such procurements can be done at a competitive price with realistic delivery timeframes, that can be quite decisive. Similarly, access to skilled labor and ability to attract and retain talent is becoming a competitive edge. So ultimately, the likely winners are those who combine financial strengths, operational expertise, diversified exposure, and strategic access to power and supply chains. The potential losers are, on the other side, those who overextend on leverage and rely on narrow counterparty base. So, in that sense, I mean, it's really the back to the fundamentals of credit discipline, diversification, balance sheet strengths, and execution capability.
So, we started the conversation talking about the investment side. We've gone into the depths of development risks. And now we want to bring us back to AI investment risks. So, to be clear, the industry's increasing reliance on debt funded expansion, which appears to be significantly outpacing equity contributions, and particularly from private credit. This raises legitimate concerns regarding its resilience to adverse market developments if AI's promise loses its shine. I was really struck by what you said, that the technological revolution never follows a straight line. And obviously, we have no idea which AI model will prevail. So this is very apt. So hyperscalers' high capex creates a high leverage environment where capital markets are driving growth, which is, inherently risky and potentially even volatile ahead of widespread organic AI adoption. S&P Global Ratings has also observed more new financing arrangements in the form of off-take and off-balance sheet arrangements that use limited purpose joint ventures and special purpose vehicles that reduce transparency. The supersized Meta deal and transaction with Blue Owl that you had previously mentioned, that is an example of a joint venture. So now for a very straightforward question. Where are prominent AI investment risks hiding?
Let me try to highlight three broad areas of concern. The first is that I would call the infrastructure ceiling. AI development is still driven by scaling laws. More data, more compute, more performance. But as I just explained, the physical world is starting to push back. Power availability, grid bottlenecks, turbine delays, nuclear recommissioning timelines, supply chain constraints, you name it. So, to give a sense of magnitude, the demand for power in the US related to AI could exceed 50 gigawatts over the next 5 years. It's enormous, and it comes after decades of flat demand. At the same time, we have chip bottlenecks that have shifted. So, for instance, access to high bandwidth memory are now critical constraints, and the large share of what is available on the market in 2026 is already committed to the tier one hyperscalers. So demand growth for just for these two physical assets is such that supply struggles to keep up with the pace. The second area of risk is technological disruption itself. The industry remains for now anchored into the idea that bigger models with more compute will continue to deliver better outcomes. But if scaling laws begin to plateau, as I just explained, and because they become also super expensive, the industry may pivot towards algorithms which are more efficient rather than just brute force expansion. We can relatively imagine that a breakthrough is in smaller or just more efficient models could suddenly reduce the need for the massive clusters currently under constructions. Similarly, improvements in GPUs or in if we have AI accelerators that reduce compute intensity per workload, that could alter the infrastructure demand assumptions. So, in other words, today's optimal scale may not be the one of tomorrow. And what's more, there's a geopolitical competitive dimension here. We have China, and Chinese firms have made significant progress in open source models, in some cases, approaching the performance of the proprietary US systems at lower cost. So now, if we start seeing open source models reaching parity with the closed systems, the premium economics of some of the leading AI labs could compress rapidly. And that would have direct implications on the investment returns across the system. So I mentioned the scaling laws, I mentioned the technology disruption. The third part is financing risk. And here, you already said, Molly, we have massive upfront capex being committed, and that's ahead of full end user productivity gains being realized. So these capex are today increasingly debt funded. And that's a major difference, for example, with what happened during the dot-com bubble. And that creates a dynamic of capital market expansion. And as I just said, especially on the debt side. So now, if we see enterprise AI adoption or measurable productivity improvements that do not materialize at pace, with so much debt leverage in place, the financial model could rapidly become much, much more fragile. So, trying to summarize all of that, what could go wrong? Physical constraints, technological disruptions, competitive shifts, financial overextensions, all interacting at the same time. And that does not mean that the AI thesis is invalid, but it does mean that the path will likely be more volatile and less linear than current enthusiasm sometimes suggests.
It's a perfect transition to our final question of our conversation, which I think will be an appropriate summary of a downside scenario of what we're watching in terms of overall credit risk. So, to close out this deeply interesting discussion on data center development, I'd love to give our audience a clear picture of ratings analytical framework on what to surveil when it comes to a potential scenario of an AI slowdown, otherwise, described as an AI downturn. So, what indicators will you and your team be watching to assess whether an AI market downturn is approaching? And what can mitigate the sector's vulnerabilities as growth continues?
It's super interesting, Molly, because you mentioned two terms, slowdown and downturn. And I would be very careful with the word downturn. At this stage, this is really not in the range of scenarios that we consider. What is indeed much more plausible is a slowdown of growth. And that's an important nuance. So when you grow extraordinarily at speed, even a moderation can feel quite abrupt. But it's not the same as a structural collapse. So we are more in that slowdown scenario. So, what should we monitor to detect this potential correction? Identified several leading indicators that provide visibility into demand, supply constraints, and capital allocation decisions. So let me start with the maybe the most fundamental one, and the one I mentioned earlier is the enterprise adoption. So enterprise adoption metrics will ultimately determine whether the current infrastructure wave is economically justified. Productivity gains, real end user uptake, and not just model performance are what sustain long term investment cycles. The challenge that we have is that these metrics tend to materialize more slowly. On the supply side, we would be looking closely at guidance from key semiconductor players. For example, the long term AI revenue visibility provided by the major chip manufacturers offer one of the clearest window into expected demand through the end of the decade. In the shorter term, memory pricing and GPU demand dynamic can signal emerging imbalances. A sharp drop in pricing or a sudden buildup in inventory would suggest that supply is outpacing effective demand. There are also operational indicators that we would love to track, such as the active user growth or the token consumption. That would be super informative, but unfortunately, at this stage, transparency remains limited, and not all of the key players report these figures on a consistent manner. So, in practice, we combine semiconductor guidance, pricing signals, capex enhancements, adoption metrics to assess whether the spending trajectory remains aligned with the underlying demand. Let me now conclude with a broader point of vulnerabilities and mitigation. At a systemic level, the sector combines very aggressive expansion, operational bottlenecks, rising leverage, and limited transparency. That mix means that if confidence weakens due to either execution setbacks or slower than expected AI demand, adjustments could propagate very quickly. And the reality, as we see it, is that market participants today are investing heavily in technologies that are still evolving without the full certainty that end use cases will absorb the capacity being built. So, if expectations were to reset meaningfully, the impact could affect credit markets, private capital valuation, or even broader economic sentiment, given notably the central role that AI now plays in the economy. But I don't want to leave you with such a doom picture and working on maybe on what could mitigate those vulnerabilities. First, greater transparency around demand metrics, around contractual structures, around counterparty exposure. Second, with well thought risk sharing mechanisms across the value chain so that the execution or the demand risks are not overly concentrated on some participants. And third, maintaining financial discipline, diversified funding sources, notably, or prudent capital allocation. If all those elements are in place, the sector would be in a much better position to absorb the volatility without turning a potential correction into something much more destabilizing for the wider markets.
There you have it. Thank you so much for your time and insights, Pierre. This was a fascinating conversation.
Thanks so much again, Molly, for having me on this Look Forward series. It was a great discussion. I hope you enjoyed it. I really had like your questions.
And thank you for listening to the Look Forward podcast. To read the research we discussed, please visit spglobal.com. I'm Molly Mintz, and I'm looking forward to advancing essential intelligence together next time.